And I think after we take out whatever that peak is going to be, that's when we're going to see the beginning of the mainstream investor start to say, whoa, gold is at 2,500, gold's at 2,600. I'm putting $1,000 into anything with the name gold in it, or anything with the name silver in it, as far as mining stocks. You multiply that out by, a couple 100 million people around the world. That's when we get the fireworks in this sector.
So some are saying that silver might just be the most undervalued asset on the planet. Silver's recently broken a primary multi-year downtrend. There have only been 4 downtrend signals in the previous 20 years. The average result is a plus 102% move, and the average period of time for those was 8 months. So it's pretty explosive. When silver breaks out and moves, its up leg is very explosive. That
Yes.
would put silver in this cycle at about $50 an ounce by December of this year. Can you speak into this? What do you expect?
Yeah, I mean, those averages that you gave are correct. The average, there have only been 4 of these primary downward trend breaks over the last 20 years, where silver is moving lower and lower and lower for 4 or 5 years in a row, and then it slices through that trend of lower prices. The average of that is over a 100% gain in 8 months following the signal. I think it's not coincidental that set of data aligns with the fact that price trajectory would take silver back to both its 1980 peak and its 2011 peak. That $50, so what I'm saying is I'm not overlaying that analysis one based on the other. Those are 2 independent data points that point to the $50 per ounce level as being reasonable. I do think that's very reasonable. Here over this year, if this cycle wants to extend into 2025, I'm open to that possibility. Silver looks very good here for this cycle, but I also have the trader side of me. I do some trading in the markets as well as long-term investing. And the trader side of me says you take the market in chunks. So we can have that as a forward-looking, reasonable goal here for the next 1 to 2 years in this cycle. But I like to take the market in chunks to say we've just broken the primary downtrend at $25. Now silver is bumping against significant resistance at 30. I would not expect it to slice through 30 on the first try. That's pretty stiff resistance dating back for the last 4 to 5 years. I would expect something of a back off from 30, maybe back down even toward 25, 26, and then more like on the second attempt. That would be my highest probability. Do I want to try to sell all of my silver at 30 and buy it back again $4 later? No, of course not. That's silly, because what if this is the time that it doesn't back off $4? What if it only backs off $3? You know what I mean? But on some of the more leveraged forms of investment, talking about, the mining sector, or if one trades futures or options or some of the leveraged ETFs, I have no problem with trading on the side to make additional profits with the primary investments staying there as well as a core. Physical metal, of course, staying as a core. In some of the leveraged forms, would I be looking to take something off the table here as silver gets to 30? Yes. And then waiting to see what sort of retracement we get. Because the retracements on a way higher, the thing to remember is that in bull markets, the down moves happen quicker than the primary trend, the primary upward trend. And it's a function of human behavior. It's because markets need to build into waves of buying support. And when you come into short-term peaks on the waves, those short-term peaks happen because for that moment in time, that window of time, all of the buyers who would buy in that, call it multi-month window, have bought. They have purchased their silver. And when you run out of buyers at a short-term peak, you get a little air pocket below the market. It literally means everyone who was going to buy for the short term is already purchased, and then there's no one left to buy. And so you get quick retracements to the downside before the next group of buyers or some of those latecomers say, hey, now we got a correction. Now I can step in here. So we always expect, the retracements to be even more violent to the downside, even in a primary advancing market.
That makes a lot of sense. So I think a lot of what you just described plays into the market psychology of metal investors. So they've been slammed down so many times in recent years that they've got PTSD. And, I understand that you leverage market psychology to gauge market and asset trends. Do you think that this gold rally is going to, quote unquote, climb a wall of worry where many are going to miss out on this initial run up and therefore keep the investment in the miners muted in a sense until they realize that the bull run is finally for real, and then they jump in at a higher price, pushing the mining equities with them? How do you see this playing out from a market psychology perspective, considering the PTSD of these investors?
Yes, I suspect that the real enthusiasm, as far as seeing more mainstream participation in the precious metal sector, will not happen until later this year, when gold forms whatever short-term peak it's going to form here within the next couple weeks or couple months. Could be 2,400, could be 2,500. I think there's going to be a sharp pullback at that point. Once that could be several $100s that gold comes back after that interim peak. I think after that interim decline finds stability, and then gold starts to rise again slowly with a little bit less, enthusiasm than we see right now just in the precious metals crowd. When we start to build back up again, then can you imagine we're back at 2,400, 2,500, let's call it 6 to 8 months from now, but there's fewer people paying attention than even today. That's what markets need to do.
Wow.
And I think after we take out whatever that peak is going to be, that's when we're going to see the beginning of the mainstream investors start to say, whoa, gold is at 2,500, gold's at 2,600. I'm putting $1,000 into anything with the name gold in it, or anything with the name silver in it, as far as mining stocks. You multiply that out by, a couple 100 million people around the world. That's when we get the fireworks in this sector. It happens again and again. The most dramatic moves in these bull markets tend to happen in the last 10% of the move. So investors need to have a core position that they're going to hold. It's one reason, by the way, that I like private placement investing in this sector for investors that are at that level where they can commit a certain amount of capital to the mining sector. Because if you invest by private placements, you're going to receive warrants, free warrants, in addition to your shares. And that what allows that you to do is to take your initial capital off the table. If the average investor did that, they have no exposure, and then they miss out on the upside. If you're holding a basket of warrants, you can take your risk off the table, sleep soundly at night, and wait for this thing to build, knowing that you still have exposure when it starts moving its way higher. So that's something that we do at iGold Advisor. We do private placement investing as well as open market investing. There's a place for both, as well as Boolean investing as a core of the portfolio. I'm just putting that out there. But yes, I think it's after this peak retracement, take out the swing peak. I think that's when we start to see the beginning of the public start to come in.
So you're expecting at that point a pretty large, sizable move in the miners.
Yes. It could really take people's breaths away at the end. I mean, I remember back from 2010 to 2011, some of the companies that lag, especially in the first wave, you have some companies right now, you have some companies that are still bumping along multi-year lows. You have some companies that are not just 52-week lows, multi-year lows. Can I mention a name or two?
Yeah, please.
The company that we're investing in right now, for full disclosure, they don't pay me a dime to say this. That's not my business model. I don't take any fees from the companies. I just talk about the investments that I'm making and that my investors are making. Serios Resources, SOI on the Canadian Venture Exchange, SIREF on the US exchange. Serios has 1.9 million ounces of gold sitting in the ground up in Quebec, Canada, politically safe jurisdiction. They're also exploring for lithium on the same properties, but they've got the existing nearly 2 million ounce gold deposit. The company is trading for a market cap of 15 million US dollars for 2 million ounces of gold in the ground. That works out to $7.50 per ounce in the ground. Gary, I'm telling you, when this market gets to a healthy standpoint, this is what happened in 2010 and 2011 into that peak. Gold in the ground, like Serios has, will be trading for $50 to $100 per ounce in the ground valuation. It's never going to trade for the same valuation as the bullion that we can hold in our hands, like my lucky Australian kangaroo here. But valuations in the range of $50 to $100 when the gold is still in the ground, that's what was normal back in 2010 and 2011 when gold prices were actually lower than they are today. It's just we had the enthusiasm higher. So if you have a company like Serios where that gold is already in the ground, I mean, exploration is great, but I'm not talking about exploration here. I'm talking about gold that already has a published 43101 official resource of nearly 2 million ounces in the ground, selling for $7 per ounce. You do the math. If that gets properly revalued to $50 to $100, but the market is totally overlooking it. And this is what happened in 2010 and 2011. The market overlooked these companies that were sitting on defined assets in the ground. And then in the final wave, in the last 6 to 8 months, a lot of these companies went up 500, 1,000, 2,000% into the final peak. This is what happens. It happens at the end. The time to look for value is now. Make your core portfolio now that you're going to hold through this cycle. It's okay to take partial profits along the way, especially you take profits from your winners and you recycle that capital back into the companies that haven't moved yet. And then you get to take a doubling or tripling of your money and try to double or triple that again in the same cycle. I'm telling you, this is what I did. It happens.
So do you see you're recommending getting those core positions now, even knowing that when we hit 2,400, 2,500, 2,600 in this cycle, we're going to see a pullback of $100, $200, $300, which means we're going to see a snap down on the miners a little bit. And then we'll get into a settling consolidation period and then our next move higher. Even though you see that coming, you're okay with building the positions now and holding through that.
You've got to go in tranches. You've got to not do all or nothing, but and it all depends on the individual, right? If it's me or if it's my clients, we already have exposure. We've had exposure going years back. So, we can take some partial profits and wait for the sector to pull back and then redeploy. If someone's approaching this for the first time, they're not in quite as good of a situation. But not all hope is lost because the valuations of these companies are still being overlooked because of that Dow to gold ratio that we talked about. The mainstream is not paying attention to this. So the strategy, if you're a new investor, would be to say, look, here's the amount of money that I intend to invest. And this needs to be risk capital. It needs to be capital that you're very comfortable seeing fluctuate by 50% in every direction, even as the sector is moving higher. That's quite normal volatility. If that would cause you to not be able to sleep at night or be uncomfortable, then you're investing capital that is not risk capital. You should not be investing savings that you have intending to purchase a property or start a business or something else like that. But for risk capital, what a new investor would do right now is to purchase partial positions somewhere in the range of 25 to 33% now, because you need some exposure now. And then when that pullback happens, average your way in on that pullback. Again, it's got to be risk capital because it will be volatile.
Yeah,
yes.
That all makes sense. So, I know you've seen this over the last week or so or more. There's been multiple gold and silver rebounds happening that were not happening in the past. In other words, when news that's negative to the metals comes out, the metals used to sink and stay down. But something is different now, as those types of situations that cause the metals to fall, they're just not keeping the metals down. The metals are responding fairly quickly. In fact, even in the same day, oftentimes you're seeing them rebound where that wasn't happening before. So several analysts are saying that they haven't seen this before in these markets, that they're having what they're calling incredible resilience. So
absolutely.
How do you explain this? Is the strength, is the resilience greed and FOMO? Is it something else? What is your take on the resilience currently in the metals?
It is quite resilient. You really hit that on the head, Gary. And I watch the metals. I pay attention to both the long-term big picture perspective. I also watch the very short run. It's not uncommon for me to be watching minute by minute price action, especially around key economic reports coming out in the morning or Federal Reserve meetings. I pay attention to how various markets are trading minute by minute. And you're absolutely right. I am seeing a dip buying mentality here, I should say, especially in silver, but gold is very strong right now. I'm seeing a dip buying mentality in these markets, a dip buying behavior that I have not seen. I have not seen this for the last 4 years. I have not seen it since the first half of 2020. But that was short-lived. That mentality only lasted for a couple months into the peak of 2020. Really, I haven't seen this type of things until we're talking early 2011. So there are buyers out there and they're waiting. They won't drive the price straight higher, though. As much as it seems like they are doing it right now, there will come a point that whatever cohort is in this market right now as those dip buyers, they will get exhausted at some point in this market, and there will be a correction. And some of the late comers who are buying some of the dips at the higher prices are going to get flushed out of the market because they bought too late, and they'll panic sell, and what will cause those swift and sharp pullbacks. It's just a function of human psychology. The higher that the price goes, the more people that get dragged in, and more people buy at the top than buy at the bottoms. And then when there's any inkling of a little correction, they're the quickest ones to go over the short run. But yeah, it's definitely a sea change of behavior. I'm seeing it as well right now. It's good to see. It's good signs here for the next 12 to 24 months.
Yeah, I would have to, if we're going to term it, it's got to be bullish, right?
Yeah.
So, all right. So at what point, or are you already, do you speculate that it could be some funds, hedge funds, pension funds, institutions that are stealth buying these dips, but only buying enough where they're capturing the downside, but not buying enough to bring attention to what they're doing at this point?
Yeah, especially in the silver market, I would say that seems about right. It's most likely hedge funds that are coming into silver right now, playing the compression in the gold to silver ratio. The other cohort that we have to think about, especially for gold right now, what's happening is you have hedgers, you have mining companies that previously hedged their production in the last 4 years of consolidation let's call it, they hedged it between 1,600 and 2,000 because that was the only range that was existing. And mining company executives, although they can be very good in certain instances of pulling metals out of the ground, they're not always the best at forecasting price behavior. And so what tends to happen from those hedgers is that after a price breaks out to new all-time highs, all of those hedgers start closing their hedge books. And also the streamers, the companies that locked into streaming agreements to sell their metals with, let's say, Wheaton Precious Metals or Franco-Nevada. A lot of those mining companies will go back to the streaming companies and say, "Hey, look, can we give you some cash to get out of those prices because we want to capitalize now on the higher prices." So that part of that bid is also that facet.
So you at the beginning of that, you just touched on the gold to silver ratio. Christopher, do you know the mean is, I think, around 50, but yet today the ratio sits closer to 90. It's up in the 80s somewhere. It's definitely historically elevated. And as you touched on multiple times here in our conversation, silver has broken through some very important resistant areas. And I believe there's one at 26, 27, and 28. Are there now legitimate reasons that the average investor should strongly consider silver miners?
There are, they're trading at multi-year lows, as we talked about some of these, especially some of the defined silver deposits that are not yet in production. Even some of the producing silver mining companies are closer to multi-year lows than anywhere near multi-year highs. So there's a lot of value in the silver miners right now, relatively speaking. Gold to silver ratio, as far as what does that need to do? Yes, it's currently in the low 80s. It's about 82, 83 right now. I'm going to revert to my trading mentality for my projection on the gold to silver ratio, even though there's a history of that trading a lot lower in favor of silver. We can look at the 1980 peak and the ratio traded down to 15. The 2011 peak, the ratio traded down to about 30. So right now we're nearly 3 times that level in favor of gold. But that said, it's not simply going to be that the ratio just compresses only because it's high from the long-term perspective. There are some key levels that ratio needs to close down below in favor of silver to show me that silver is going to really start catching up to gold. Specifically, the 80 level, 80 is a key technical level on the charts. So if we can start closing below 80, it starts to signal to me that the catch-up period for silver is upon us. But I like to go with if-then statements. Until I see that close below 80, we're not there yet.
So, okay. So talking from a market psychology perspective, when it comes to silver, in my opinion, when I talk to people, it's still gold and silver. It's still connected to gold. It's the little sister, the little brother, so to speak. Do you see that as gold continues to go up in price, and even after a pullback, we hit 24, 25, 26, it pulls back and then starts making a move to 3 or whatever number, 35, 4. There is some number there that becomes psychologically cost prohibitive to some people. And they say to themselves or within themselves, I need to get into the metals. Gold is, 3,000, 3,200, but look at silver. It's at $40. Why don't I get into silver and silver related? And then you start to see silver go much higher because the average investor, I don't mean that man like as in man, woman, but the average person, the average investor starts moving towards silver because of the cost prohibitive nature of gold.
Yeah, I think we're close to that point now. I think the level is going to be around 2,500 for gold. I think above there, psychologically, a quarter of the way to 10,000, somehow that feels like a number that's going to cause a lot of people to step back. I remember back in 2010, 2011, I had when gold was above 1,500, but silver was still in the 17 region. That's when I started to have a lot of those people coming to me and saying, hey, I've got a few $1,000s. I'm not just going to buy 1 or 2 ounces of gold. I want to buy a few 100 ounces of silver. I think it's 2,500 this time. That's my gut. That's my gut feeling.
So you do see that psychology unfolding at some point.
It will happen, and then the larger phenomenon that'll be really interesting is when some of those people say, okay, yeah, so someone wants to put $500 into silver, which is trading at at $50 per ounce, let's say, so they could get 10 silver coins, or they could buy 500 shares of a silver mining company that's trading for $1 per share. And you multiply that psychology out by a few hundred million people. That's when things get very interesting. It happens in every cycle. It's a very distinct phenomenon to watch.
Yeah, well, I'm looking forward to seeing that unfold.
Yes, as am I.
So, all right. So I do have a question for you on the broader commodities area, the CRB commodities index. It's moved quite a bit higher over the last 1 to 2 months. This clearly correlates with inflation marching higher. Some believe that we're just at the dawn of a new commodities super cycle. What is your outlook for commodities based on your proprietary technical analysis and your study of cycles?
I'm going to defer back to that Dow to gold ratio chart that we looked at, that generational consolidation where those two trends, gold is the ultimate commodity, and the Dow is the longest index that we have for stocks and industrial capacity. So right there, you're looking at the convergence between commodities and industry. I think the direction that breaks is going to answer that question. I can't make a call on it, though, at this point. From a fundamental standpoint, I believe that we as human beings, it's not just a belief. The data shows this. We look at commodity production for almost all commodities. There are just a few exceptions for very rare metals, but almost all commodities, we simply get more efficient at producing them as time goes on, as we should. You look at all the past cycles, oil production. I remember everyone saying back in 2007, 2008, at the peak of oil, that we're reaching this peak oil phenomenon where, we're seeing exponential growth in the human species amidst flat, production for oil. Totally bogus, totally out the window. We have gone year over year over year over year, higher and higher production, not only in oil, natural gas, not only in the liquid hydrocarbons, but in renewable energies. We are very efficient as human beings at extracting resources and converting them into real form. So I don't put that behind us, but as far as, are we going to be in a cycle of, let's say, a decade or two of commodity outperformance, which can happen even as we get more efficient at producing them, I'm going to wait until that Dow to gold chart breaks.
Okay. And that's a within, in your opinion, based on your analysis, within 24 months, sometime within the next 24 months.
Absolutely.
Yeah. All right. So, Christopher, before I get to the final question, I want to ask you, with everything that we've discussed as a backdrop, how are you positioning moving forward? What assets do you like? What don't you like? What are you staying away from? And I'm talking broad. I don't mean individual names.
I like, I'll tell you, I am, as far as my investing themes here over the next 12 to 24 months, I'm entirely focused on the undervalued precious metals producers that should see the most dramatic waves higher in the final wave of this cycle. That doesn't mean that I have all my cash in precious metals producers. I have some cash just sitting in short-term investments in fiat currency. I have no problem with that. As long as I'm close to matching the rate of inflation, I think there is a wisdom to keeping some cash on the sidelines, because you never know when we're going to get one of those market crashes that causes real estate, land, energy producing properties to fall 30, 40, or 50% in just a couple of months. So I like having some cash on the sidelines. But as far as the next 12 to 24 months, as far as my investments go, I'm entirely focused on the reversion potential. I mentioned Serios Resources. It's one example. There are dozens of companies that fit this profile that have this life altering. I don't shy away from using that word. If you have a company that goes up tenfold within 24 months, which is entirely doable into a final wave, that will be life altering for many people. You can then take a step back and say, what is it that I would like to do with my time on planet Earth? Do I really want to keep working this job that I'm working? Do I really want to live where I have been living? We don't get life altering reversion potentials every year or even every decade. The last time that we've really had this was 2010 into 2011, this setup for a really powerful final wave. But it's not just that, because if you waited until 2011, like most people, a lot of the revaluation had already happened. We're in this very unique window right now where, because of that Dow to gold ratio, the mainstream investor has been overlooking the precious metals sector. And because of that, the valuations on a lot of these defined deposit mining companies, a lot of these junior mining companies, the valuations are 1/10 of what they were 10 years ago when gold was lower than it is today. And that valuation discrepancy is entirely a function of human psychology. It's entirely a function of the average investor simply not paying attention to this sector. So if the revaluation had already happened, like it had in 2011, I would not be saying this is the time to really look at a basket of these companies for that life-altering potential. I would be saying, you want to diversify, you want to take some off the table here, consider other investment themes. Next 12 to 24 months look to be this window. After that, I'm going to watch the way that the Dow to gold ratio breaks. If it breaks in favor of gold, we look for value even further down the totem pole. What are going to be the next rung of companies to see revaluations? Because it doesn't all happen at the same time. But if we see the Dow to gold ratio breaking out in favor of the Dow, we take a lot of our chips off the table in gold and silver, and we say, what are the themes in technology and industry that are going to be leading for the next 10 to 20 years after that? That's my high level.
Yeah, no, it's amazing. There's so much wisdom in that. And I just want to underline for those who are viewing what you just stated about having some cash on the sidelines for an event that could take place. Will an event take place? We don't know that. It certainly looks like probabilities are increasing, though, that an event could take place. And even just to have that cash on the sidelines, so to play the dip you were talking about, coming down and in gold after it hits that 2600, comes down and then starts the final push to be able to take advantage of that. So I just wanted to underscore that. I think that's just so critical to have that cash on the sideline. So before I wrap up here and I ask Christopher our final question, I want to point everyone over to our Substack. It is free. Go to metalsandminers.substack.com. We post free content on the consumer, the economy, markets, artificial intelligence, individual metals and miners, and every interview that we conduct. It's all up there. And when you subscribe, we're going to give you a free gift. It is a report that we wrote. It's based on the important Ray Dalio foundational premise. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." It is a critical read. This is a free gift. You must get it. Everyone needs to understand why they need to own gold at this very moment. So head over to metalsandminers.substack.com, put in your email address, subscribe, and receive the free gift on us. If you've enjoyed the conversation with Christopher as much as I have, please let him know. Hit the like and subscribe button, and please leave a comment below the video. Okay, in wrapping up the discussion, I've got a final question for you. All right.
Yes.
As a former CIA drone officer, you have been part of experiences and training that the overwhelming majority of us just have not been privy to. So, with this background, what are you expecting politically and geopolitically for the remainder of the year as we head towards the election? Are you expecting increased volatility, a black swan event, war, mass rioting, or plain old peace and calm? What are you expecting, and how do you see the remainder of the year playing out?
Mm. Um, and so my background in military intelligence analysis, I just want to draw the analogy to the type of analysis that I do in the financial markets. The reason why I make this analogy is I was an analyst on the drone program working with special operations in Afghanistan, and I would have military commanders come to me and say, "Hey, we're looking at a target on the ground. We want to know, is the bad guy there? Are there women and children in the compound?" The answer that I would give to that would oftentimes determine whether or not there would be a bomb dropped on that target within a few minutes or not. And so there was not a whole lot of time for discussion about 100 different things that were going on in the background. And so it's, what do we need to know? What's your best assessment on it? You got 5 minutes to give me an answer. Technical analysis is about cutting through the BS of 100 different stories going on in the background, some of which may be true, some of which may not be true, and saying, what's the most important thing that we need to focus on? So that's how I arrived at this analogy of military analysis to financial analysis. I also wanted to leave the world when when I saw the direction of the wars going in a way that I could no longer support back in 2007, 2009. As someone who went into the military world as a patriot, wanting to help the United States and the world to find more security and more peace, stability, I observed with my own eyes that what I was being told on the news was not what was happening in the ground. The wars were resulting in more instability, more casualties on both sides of the conflict. And so I said to myself, even though this was something that I wanted to do from a fundamental standpoint, I could no longer align with it. And I'm glad that I left that world. There are better things to be doing with one's time than fighting wars. Look, wars are going to happen. It appears like we are on the precipice of what could morph into a larger conflict. History books are not written. Even the quote unquote control structures around the world, the elites, as some people call them, they're not entirely in control either. So the events of the world are not written ahead of time. I'm not married to the thesis that this is the start of World War III. This could be simply the start of a regional conflict that goes on for some time. I think when we look at the broad stroke of history, though, the upward march of progress for humanity as a whole is distinct and unrelenting, in spite of wars, in spite of the attempts to hold us back as a species, despite the nefarious attempts to rob our wealth by inflation and excessive taxation. We've been on an upward march. We're on an upward march. The very fact that we're having this conversation from halfway around the continent and communicating with so many people and all the other things that we have access to, we live, you and I and everyone out there lives like royalty lived 300 years ago. Literally the ability to pick up, and if we wanted to, if you and I wanted to, and if most of the people listening to this wanted to, we could get on a plane and be having dinner on a cliffside in Italy tomorrow, if we wanted to, looking over the beautiful Mediterranean, if we wanted to. You're telling me that 300 years ago, how many people could fathom that? Even 100 years ago, probably not 1 out of a million people would be able to do what we can do now. So conflict may happen. It may get bad. You know, if certain mistakes are made along the way, this could morph into a World War III type of scenario. I am looking at, you know, what's going on, especially in the Middle East, kind of merging with Russia and Ukraine there with some concern. But ultimately, I think we're on the right path. We shore up ourselves. We shore up our own defenses, our own sovereignty, personally, our finances, our health, our situation, our connections with other human beings. And then we go out and we live this life. We don't hide away in fear despite any of the things that are happening in the world. We have to be prudent. There are times to take a step back and hunker down for a while. When I was in the war, it was time to sometimes go into the bunker for a few moments in time. But we're going to be all right, and we're on the right path as a species. I think the data really shows that.
I really appreciate your positive nature. You have a very positive nature. You speak very positively about the human race, about human development, about human progress, and that impact, you know, on us for tomorrow, for our children, for our grandchildren. So thank you for sharing that positive nature of yours. Thank you for coming on to Metals and Miners. Thank you for being so generous with your time and your analysis and your ideas. It's been awesome to spend this time with you. Will you tell the viewers any final thoughts that you want to share with those tuning in, where they can learn more about your work and how they can connect with you?
Yeah, thank you so much, Gary. The website is igoldadvisor.com. You can find me on X or Twitter at iGlobalGold, or you could just Google search Christopher Aaron Gold and you'll find me. I just think as final words here from the investment standpoint is just to keep in mind the rare setup that we have here immediately in front of us, with valuations in this sector still about 1/10 of what they were 10 years ago, with the metals prices now above where they were 10 years ago for gold. That's not going to last very much longer. Think about taking advantage of some of that opportunity. And yes, I look forward to speaking with you again the next time, Gary.
Yeah, I look forward to having you back on. Everybody, I'm going to put all of that information that Christopher shared about where to find him, where to connect with him, in the description below and on the screen, so you're all going to see it. Please go follow him, interact with him. He has a wealth of knowledge, a fantastic perspective. Thank you for being here. Everybody else, thank you for watching.
Thank you.
When you subscribe, we want to give you a free gift. It's a report that we wrote based on an important Ray Dalio foundational premise titled, "If You Don't Own Gold, You Know Neither History Nor Economics." This free gift is a must read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe. It's free, and get the free gift.